Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 9, 2017. We're looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. And as you'll notice today, we're butting up against an area where I think we're going to run into resistance. And it goes back to something we discussed last night, which is, and we discussed this time and time again in various markets, which is how far extended we are from home base or the 20-period moving average. Now, the markets are in an uptrend, and there's technically nothing wrong with the market. We're nowhere near having any kind of a hard sell signal for the market. However, we are in an area where we're extended, we're overbought, and the market really does need to pull back, take a breather, at minimum of go sideways to eat some time off the clock and let the 20-period moving average come up toward price. You'll notice that we've been up for 6 days in a row, including today, and generally speaking, when we're up about 6 or 7 days in a row, the market's due for somewhat of a breather. So we'll see what happens over the next trading session or two, and we'll see if we get that pullback that's long overdue. Again, I'm not looking for a huge correction. I'm just looking for the market to work off some of the overbought condition. We went up on relatively light volume today. 56 to 57 million shares traded in the SPDR is relatively light volume. You'll notice down here at the bottom where the black line runs through the volume averages, the average volume, and this is a 90-day average volume, is about 75 million shares. So we're below average, and anytime we're below average, what that tells you is there's not a lot of participation in the market. There's not a lot of institutional participation. What it also tells us is a lot of the trading that goes on in light volume markets is typically computerized trading, buy programs, sell programs. It's not a lot of institutional conviction, and when we don't have a lot of conviction, the markets tend to stall out, which is also a perfect recipe for us to work off some of the overbought conditions. So that's what I think is happening in the SPDR. Maybe we go up a little bit more, but I just don't think there's a lot more in the tank or that much more in the tank from where we are based on how far extended we are from home base. We'll take a look at the IWM, or the Russell 2000 index, and even though the SPDR was up about 40 some odd cents today, or about 0.16%, the IWM was down 0.2%. Now, it's not a big disparity. It's not down a whole lot. 30 cents down in the IWM is not a whole lot at all. What we did today, though, is we did make intraday a new high in the IWM. The high today was 155.50. The old high intraday was 155.41. So while we made an intraday high, the market was rejected at those highs, and we actually finished down on the day. So to me, I take that as somewhat of a negative sign that the IWM was not able to continue higher, was not able to close at a new high, and actually finish negative on the day. I take that as a slightly negative sign across the markets, and it just tells me that the market is overbought and needs to, at minimum, work off some of the overbought condition. You know that the IWM is my favorite leading indicator on the up and the downside, and the fact that the IWM was not making new highs while the Dow was making new highs, while the S&P was making new highs, and while the NASDAQ composite was making new highs, that was to me somewhat of a warning sign, and we're not able to close at a new high in the Russell or the IWM today, so I'm taking that as somewhat of a warning sign. If things change and they flip around and the IWM powers forward and makes a new high and a closing high, then things will change and the markets are free to move higher. I just don't think that's the case today. I'm not saying that can't happen later. I just think the markets are overbought and we're long overdue for a little bit of a correction. We'll also look at the VIX tonight. And last night we talked about the VIX and the fact that the VIX was up in the face of a market that was up. And today we had it again. The VIX was up almost 6% while the S&P was up, while the Dow Jones Industrial Average was up 0.4%, and the NASDAQ was basically up 6 points. That's close to flat. It's just a rounding error in my opinion. However, the VIX was up, and to me, just like last night, it's a tell. It's a telltale sign that somebody out there, and it's not just one person, but somebody out there is buying protection on the markets. So they're buying protection in the form of puts, and that's driving the price of the VIX higher. And each and every time the VIX gets below 10, certainly down in the low 9s, I pound the table and I say, this is where you want to begin to build or collect a position in the VIX index, whether it's through call options or whether it's through one of the exchange-traded products that tracks the VIX. That's an area where if you give yourself enough time, you're generally rewarded. So over the last couple of sessions, the VIX is basically up a little more than 10% from the lows. That's precisely what I was referring to when we were down there. Looking over at the transports, my second favorite leading indicator of the market, nothing wrong with the transports. They were up 20, 21 points today. Obviously overextended, just like the S&P 500 is. However, a market can stay overextended for longer than most people can stay solvent. We're certainly far enough away from the 20-period moving average where I would think the market would want to pull back or at least go sideways and let home base come up into price at a bare minimum. However, we are in a very strong uptrend in the transports. That bodes well for the markets. That's healthy for the economy, or at least it's a sign of health. Net, we are in a very strong uptrend for the transports. Even if we pulled back for a few days, that's not going to harm the longer-term uptrend in the transports. Just to put that in perspective, here's the weekly chart of the transports. Even if we came down 500-600 points in the transports, that's not, or more, that's not going to harm the longer-term uptrend in the transports. You can see the moving averages are all pointed upwards. We're beginning to see spacing in between the 20 and the 50-period moving average. That's all bullish for the transports. This is the weekly chart, and what this is telling us that the long-term picture for the transports has the market going higher. And by the way, even if we came down 1,000 points in the transports, roughly, that puts us right at the 20-period moving average, and that's also right at the last breakout point where the transports broke out on the weekly chart above the old highs. So even if we came down 1,000 points in the transports, all that would really do from a weekly chart perspective is work off the overbought condition, but it would not damage the uptrend and the technical picture in the transports from a long-term perspective. Tonight, we'll talk a little bit about the broker-dealer index. Well, here's the weekly chart, and you can see here, I'll go back to the daily, but you can see the weekly chart. It's just been powering forward, again, just like the other markets, extended from home base or the 20-period moving average, but this is a very strong uptrend. When we go back to the daily chart, you can see the same thing. So we're in a very strong uptrend, nothing wrong with this index. We can come down in the broker-dealer index back to the 20-period moving average and still not pose any damage to the uptrend whatsoever. The reason why I like to look at the broker-dealer index, and the same thing is found in the XLF, which tracks the financial sector as well, is because without the financials on both directions, without the financials, the market is unlikely to go higher, so you need the financials to participate on the upside, and also on the downside, if the market was in any kind of significant trouble ahead, the financials would be telling us so, and the financials are not. They're not telling us that there's any trouble in this market whatsoever. If something changes and we have a reversal in our hands, that's fine. We'll discuss it here. But right now, as it stands, there's no trouble in the financial sector. Therefore, it's unlikely that we see a long, hard sell in the major markets without participation from the financials. It's just unlikely to happen. We'll change gears and we'll look over at the gold market. And you see we had a little bit of a pullback today in gold. And I talked about this last night, that we shouldn't be surprised if we see gold come down to the 1306, 07, 08 area. Today's low happened to be 1309.50, so we could still come down a little more, and it won't damage the uptrend in the gold market at all either. What would happen is it would just be a continuation of a consolidation pattern that seems to be forming in the gold market. And what this is telling me, if this consolidation pattern continues, it's telling us that the gold market is consolidating or building energy to make another move higher, possibly up to the 1338 to 1340 area that we cited last week. Most likely, the gold market needs a couple of more days of consolidation before making another move higher, if it's going to do so at all. I wouldn't be long the gold market right here. I think there's probably some more downside in the cards. I wouldn't be short the gold market because I don't think there's that much more downside in the cards. I just think it's a consolidation pattern. Also, likely to find support, even if we got down this low, this would be an area we're likely to find at minimum of intraday support. If this area didn't hold, you would go all the way down to the 100 period moving average, right around 1294, 1295. That would be a second area of support. I don't see much more downside than that right now in the cards for gold. If something else develops, we'll obviously discuss it here. Crude oil. Here's another market that's in a perpetual uptrend. Very, very strong uptrend in crude oil. Again, just like the other ones, getting too far extended from home base. So while we can see higher prices coming, certainly we're going to have to see some kind of either a pullback or the crude oil market go sideways for a period of time and let the 20 period moving average come up toward price, or let price come back toward the 20 period moving average. Needs to work off some of the overbought condition. But remember what we talked about last night is that we can go higher in crude oil. There is an area, and it's better seen on the weekly chart. We can go all the way up towards this 200 period moving average. That's this downsloping black trend line. It also somewhat coincides with this pivot top over here, and you can see that if we did continue higher in crude oil, that we're likely to find an area of resistance somewhere in the neighborhood of this old pivot top. The actual number happens to be 6902. The 200 period moving average comes in slightly above that, but will creep downward over time. I'm not suggesting we get up there in one shot. However, this is a very, very strong move and a very strong uptrend in crude oil. I don't see why it won't continue. The only thing is we probably need to at least consolidate for a period of time before resuming another leg higher. We'll see if this particular move stalls out at 63.50, maybe even 64, but beyond that, it's unlikely we go much higher than that without some kind of a consolidation or pullback occurring first. Just like the other markets, the trend is up. The trend is your friend until the very end. Tonight, we'll take a look at the bond market, and the bond market is breaking down. And my long-term view, for those of you that have been listening for a while, my long-term view on the bond market is that there's going to be a lot of downside over the coming months and years in the bond market. That means that yields are set to rise, but it's going to be a long-term process. Nothing overnight, nothing's going to happen tomorrow or next week. However, we are beginning to see a breakdown in the bond market, and this is the flip side to the yield chart. This is the 30-year bond. So we look at the 30-year yield chart, and you can see here where yields are on the way up. What this is telling us, and whether you look at a 30-year yield chart or a 10-year yield chart, this is the 10-year Treasury note interest rate. What happens is this is telling us that the Federal Reserve is going to continue to raise interest rates throughout 2018. They think the economy is healthy. The economy appears healthy. It's an excuse for them to begin to get off of ground zero with interest rates and continue to raise interest rates to get out of the pickle that they're in and get some of the bonds that they have on their balance sheet off the balance sheet and try and trim down the size of the Fed's balance sheet. All that is fine. It's a little bit complicated. We don't need to get into that. What we need to understand is while a little bit of a rise in interest rates is okay, a significant rise in interest rates will ultimately stifle the economy. I'm not suggesting that's going to happen this year, but over time, when rates get too high, it has a negative impact on the economy. It has a negative impact on the stock market. That's what happened to the housing bubble that burst in 2006. Interest rates went up too far too fast, and that popped the housing bubble. And essentially, we know the story, what happened after that. The market declined starting in late 2007 all the way into early 2009. And if we see a significant decline in the bond market, and I'm going to bring a long-term chart up here in a second. So if we look at a monthly chart of the bond market, what we see here is a very bearish pattern. Okay, so here's a down move, and we've been consolidating in what's called a bearish wedge pattern for quite some time. Generally speaking, until and unless we close above this area right up here, which isn't apparently happening anytime soon, then this will generally play out to the downside. And if this plays out to the downside, and this could be a long-term slog all the way down. We're not going to discuss how far down it can go right now. It's not really important today. But what that would do is have an inverse relationship to yields. So if the bond market is going down significantly, yields are going higher significantly, and that ultimately, and I could be 2-3 years out from now, but when this does occur, a very rapid rise or a significant rise in interest rates will have a negative impact on the economy, and it will have a negative impact on the market. When money isn't cheap anymore, everything will change. This is a long-term process. Just wanted to bring it to our attention. Nothing we have to worry about today. Nothing we have to worry about tomorrow. It's a long-term process. The last thing I thought we would do tonight is check in with some of our market-leading stocks, the FANG stocks, if you will. If they're healthy, generally speaking, the market's going to be healthy, at least until proven otherwise. So first we have a look at Apple, and what Apple's doing here is making a long-term, this is the daily chart, consolidation pattern. So there's nothing wrong with Apple. When we even look at the longer-term chart, you can see here, this is on a weekly chart. It looks like it's consolidating on the weekly chart, and it looks like it wants to break out to the upside. We can have some backing and filling here, but certainly this is in a long-term uptrend. There's nothing wrong with Apple. Apple looks very strong. The trend is your friend until the very end. The next one we'll look at is one of our other favorites in Netflix. So the Netflix chart obviously extended away from the moving averages, so maybe it needs to pull back, maybe it needs to consolidate for a while. But again, Netflix, very strong chart. Even when we look at the weekly, we had a breakout last week, and we'll see if we consolidate up here, pull back a little bit. But again, the trend is up. There's nothing wrong with this stock. This is telling us that there's still buyers underneath this market. Very strong uptrend, nothing wrong with Netflix. How about Amazon, another market-leading stock? When you look at the weekly chart, you can see here we are getting a little bit extended. However, nothing wrong with Amazon. We continue to make new highs. Look at the daily chart. It's overextended, probably needs to pull back a little bit. But even if it pulls back down to, let's say, 1220, 1215, 1210 in this area, while that might seem like a lot, it's really not from a percentage standpoint. Nothing wrong with Amazon. The trend is up. The trend is very strong in Amazon. Chart of Google. Google L is the one we'll look at. Again, same chart, a little extended on the daily chart, but nothing wrong with this chart. It's a very healthy stock. It's a very healthy chart. The trend is your friend. The trend is up in all these stocks, and therefore, if the trend is up in all these stocks and money is not coming off the table in some of the market-leading stocks, that tells you that the hedge funds and the mutual funds that hold these stocks, they're not interested in selling them, they're holding them. Therefore, the long-term outlook should still be higher for not only these stocks, but their major markets as well. We'll have corrections along the way, but this is a very healthy way or an easy way to look at the health of the markets from the leading stock perspective. And with that, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.